January 2026, Social Security. Why this new year feels different for millions of retirees. As we close out the year and step into January 2026, millions of Americans are paying closer attention to their Social Security payments than usual. A new year always brings changes, but January matters more than most months because this is when new benefit amounts actually begin showing up in real deposits. Not just numbers on paper, but real dollars that determine whether a household budget feels manageable or stretched. For some retirees, January brings a small sense of relief. A higher payment can help cover rising grocery bills, utilities, or prescriptions. For others, it raises new concerns about whether that increase will truly keep up with everyday costs that still feel uncomfortably high. Inflation may have slowed compared to previous years, but for many older adults, prices have not gone back down. The pressure remains. That is why the January 2026 Social Security payment schedule is drawing so much attention. This month includes early payments, holiday adjustments, and calendar shifts that can easily cause confusion if you are not expecting them. Some deposits arrive before the new year even begins. Others fall later in the month than usual. And for certain households, payments appear closer together than normal. Understanding what is happening and why is essential. Not because something is wrong, but because the system follows strict rules tied to holidays and federal payment schedules. Knowing how those rules work can help prevent unnecessary worry, budgeting mistakes, or the false belief that an extra payment has arrived. In this series, we will walk carefully through the January 2026 payment dates, explain who gets paid when, and break down how benefit changes, Medicare costs, and broader policy shifts may affect what actually lands in your bank account. Early SSI payments, why January 2026 starts before the new year. One of the first surprises many people notice when reviewing the January 2026 payment schedule is that some deposits arrive before the year even begins. This is especially true for supplemental security income recipients. In January 2026, the SSI payment is scheduled to arrive early on Wednesday, December 31st, 2025. At first glance, this can feel confusing or even exciting. Seeing a payment hit your account before New Year's Day may create the impression that something extra has been paid out. But it is important to be very clear about what this payment represents. That deposit is your January SSI benefit. It is not a bonus. It is not a duplicate payment. And it does not mean the system made a mistake. The reason for this early payment is straightforward. January 1st is a federal holiday. When the first day of the month falls on a holiday, the Social Security Administration sends SSI payments on the last business day before that date. In this case, that business day is December 31st. This timing rule has existed for many years, but it can still catch people off guard. And for individuals living on a very tight monthly budget, misunderstanding this early payment can lead to problems later in the month if the money is spent too quickly. That is why planning ahead matters. Even though the payment arrives in December, it must last through January. Treating it as early access to January's income, not extra cash, can help avoid unnecessary financial stress as the new year begins. Who gets paid on January 2nd? The Special Social Security Group. After the early SSI payment on December 31st, the next important date on the January 2026 calendar is Friday, January 2nd. This payment date applies to a specific group of Social Security recipients who follow a different schedule than most others. If you began receiving Social Security benefits before May of 1997, your payment is scheduled for January 2nd. The same is true for individuals who receive both Social Security and supplemental security income. This group is not paid based on birthdays. Instead, they follow a fixed monthly schedule that remains consistent even when holidays shift other payments around. Because January 1st is a federal holiday, payments that normally would be issued on that date are pushed to the next business day. In 2026, that business day is January 2nd. So if your deposit arrives on that Friday, it is exactly on schedule. For many people in this group, seeing their payment arrive so early in the month can be reassuring. It provides immediate access to income at the start of January when bills, rent, and other monthly expenses are often due. However, it is still important to remember that this payment must last the entire month. Understanding which payment group you fall into can eliminate unnecessary worry. A deposit on January 2nd is not early and not late. It is simply how the calendar and long-standing Social Security rules work together when a new year begins with a holiday. Birthday-based payments. Understanding the January 2026 schedule. For the majority of Social Security recipients, January 2026 payments are issued based on birth dates. This system has been in place for many years, but it still causes confusion, especially when holidays and New Year transitions are involved. If your birthday falls between the 1st and the 10th of the month, your January payment is scheduled for Wednesday, January 14th. If your birthday falls between the 11th and the 20th, your payment arrives on Wednesday, January 21st. And if your birthday falls between the 21st and the 31st, your payment is scheduled for Wednesday, January 28th. These dates may feel later than expected, particularly after seeing early payments go out to SSI recipients and those paid on January 2nd. But this timing is normal and follows the standard Social Security calendar. One important point to remember is that none of these payments are delayed. Even if your deposit does not arrive until the middle or end of the month, it is still considered on time. The payment schedule is designed to spread deposits evenly throughout the month to keep the system running smoothly. Checking your birth date group ahead of time can help you plan your expenses more confidently. When you know exactly when your payment is coming, you can avoid unnecessary stress and focus on managing your monthly budget with clarity. 2. SSI payments. Close together. What's really happening in January? As if the early January payment were not confusing enough, there is another calendar detail in early 2026 that SSI recipients need to understand clearly. In addition to the January SSI payment arriving on December 31st, some people will see another SSI deposit appear near the end of January. This happens because February 1st, 2026 falls on a Sunday. When that occurs, the Social Security Administration issues the SSI payment on the last business day of the prior month. In this case, that date is Friday, January 30th, 2026. So for some SSI recipients, two payments appear within the same calendar month of January. One payment issued on December 31st is for January. The other payment issued on January 30th is for February. This timing can easily create confusion. It may feel like extra money has arrived or that benefits have increased suddenly. But it is very important to understand that no additional funds are being paid. These are simply two regularly scheduled payments that fall close together because of how weekends and holidays line up. For people living on fixed incomes, this situation can be risky if not planned carefully. Spending both payments without realizing one belongs to the following month can lead to serious shortfalls later. That is why recognizing the purpose of each deposit is essential for maintaining financial stability. When the money actually arrives, direct deposit and payment timing. Knowing the official payment date is important, but for many people, what matters just as much is when the money actually shows up in their account. In January 2026, this detail becomes especially relevant because of early payments, holidays, and closely spaced deposit dates. For individuals using direct deposit, Social Security payments typically arrive overnight or early in the morning on the scheduled payment date. The exact time can vary depending on your bank. Some financial institutions process deposits shortly after midnight, while others post funds closer to regular business hours. For those using the Direct Express card, payments are generally loaded on the same day as scheduled, but the timing can still differ. Some people may see their funds in the early morning, while others may not see the deposit until later in the day. It is also important to understand that minor delays can happen, especially around holidays or weekends. If a payment does not appear immediately, the Social Security Administration recommends allowing a few business days before contacting them. Banking systems sometimes experience brief processing delays that resolve on their own. What matters most is staying calm and informed. Checking your account repeatedly throughout the day can add unnecessary stress. Knowing your scheduled date, understanding your bank's usual processing time, and allowing for small delays can help you feel more confident and avoid panic when payments do not appear at the exact same hour every month. The 2026 COLA increase, what a 2.8% adjustment really means. Along with the January payment schedule, one of the most closely watched changes at the start of 2026 is the cost of living adjustment, often referred to as COLA. For 2026, the COLA is set at 2.8%, and for most beneficiaries, it begins with the January payment. On average, this increase works out to roughly $56 more per month for retired workers. For individuals receiving disability benefits or survivor benefits, the exact increase varies depending on their current benefit amount. On paper, any increase sounds positive. After all, Social Security is designed to help benefits keep pace with rising costs. For some households, that additional amount can help offset part of a grocery bill, a utility increase, or the cost of a prescription. Even small increases can make a difference when every dollar is carefully planned. However, many people feel that this increase does not go as far as they hoped. The reason is simple. While benefits are rising modestly, many everyday expenses remain high. Food, housing, insurance, and medical costs continue to strain fixed incomes. So although the COLA does raise monthly benefits, it often feels more like a partial cushion than a true financial boost. That gap between expectation and reality is why understanding the full picture matters. The COLA increase is real, but how much of it you actually feel depends on what happens next, especially when Medicare costs are factored in. Medicare Part B premiums. Why your net increase may feel smaller. For many Social Security beneficiaries, the COLA increase does not tell the full story. While the gross benefit amount rises in January 2026, what actually reaches your bank account can feel noticeably smaller. The main reason is the increase in Medicare Part B premiums. For 2026, the standard Medicare Part B premium rises to $22.90 per month. For most people, this premium is deducted automatically from their Social Security check before the payment is deposited. That means the increase you see on paper is reduced before you ever receive the money. This is why two people can receive the same COLA percentage and still have very different experiences. One person may notice a modest increase in their deposit, while another sees little change at all. In some cases, the Medicare premium increase absorbs a large portion of the COLA. There is a protection known as the hold harmless rule, which prevents many beneficiaries from seeing their Social Security checks decrease due to rising Medicare premiums. However, this protection does not apply to everyone. New Medicare enrollees and some higher-income beneficiaries may feel the full impact of the premium increase. Understanding this interaction between Social Security and Medicare is essential. It explains why January deposits can sometimes feel disappointing, even when benefits officially increase. Knowing what is being deducted and why helps set realistic expectations and prevents unnecessary frustration as the new year begins. Social Security goes digital. Convenience, concerns, and real-life challenges. As January 2026 approaches, changes to Social Security are not limited to payment amounts and schedules. How people interact with the system itself is also evolving. The Social Security Administration has been steadily moving toward a digital-first approach, encouraging beneficiaries to handle more tasks online whenever possible. On the surface, this shift offers clear advantages. Online access allows people to update direct deposit information, download benefit verification letters, and manage their accounts without traveling to a field office or waiting on hold for long periods of time. For many beneficiaries, especially those comfortable with technology, these tools make managing benefits faster and more convenient. At the same time, this transition raises real concerns. Not everyone has reliable internet access. Not everyone feels comfortable navigating online systems, and for many older adults, resolving complex issues still feels safer and more effective in person. As in-person visits are reduced and offices become busier, some people worry about losing the personal support they rely on. Staffing changes add another layer of uncertainty. Reports of workforce reductions and the loss of experienced employees have led critics to question whether technology alone can handle the growing demand. While supporters argue that digital tools improve efficiency, others fear that fewer staff combined with stricter procedures could make it harder for vulnerable individuals to get timely help. For many beneficiaries, the challenge is finding balance, embracing useful technology without leaving behind those who need personal, face-to-face assistance. Identity verification and fraud protection. Security comes with trade-offs. Alongside the shift toward digital services, Social Security has also placed a much stronger emphasis on identity verification and fraud prevention. This focus is not accidental. Scams targeting Social Security beneficiaries have become more frequent and more sophisticated, costing older Americans millions of dollars each year. To combat this, the agency has tightened its security procedures. Identity checks are now more detailed. Certain actions, such as filing claims by phone or making changes to direct deposit, may require additional verification steps. In some cases, beneficiaries are asked to provide more documentation or even appear in person to confirm their identity. From a security standpoint, these measures serve an important purpose. Stronger verification helps prevent criminals from stealing benefits, redirecting payments, or gaining access to personal information. For many people, knowing that extra safeguards are in place provides reassurance that their income is being protected. However, increased security also comes with trade-offs. For legitimate beneficiaries, especially older adults with mobility issues, health concerns, or limited access to transportation, additional steps can feel burdensome. More paperwork, longer wait times, or required office visits can turn routine tasks into stressful experiences. This creates an ongoing challenge for Social Security. The system must protect against fraud without making access unreasonably difficult for the very people it is meant to serve. As 2026 approaches, finding the right balance between security and accessibility remains one of the most important and most debated issues facing the program. The Social Security Fairness Act, long-awaited relief for public servants. As the conversation around January 2026 continues, there is one development bringing genuine relief to a group of beneficiaries who have waited many years for change. The ongoing implementation of the Social Security Fairness Act is reshaping outcomes for millions of Americans affected by long-criticized benefit reductions. This legislation ends two provisions that significantly reduced or eliminated Social Security benefits for many public servants. The windfall elimination provision, known as WEP, and the government pension offset, or GPO, impacted individuals who earned pensions from jobs not covered by Social Security. Teachers, firefighters, police officers, and other public employees were among those most affected. For decades, these rules lowered monthly benefits or eliminated spousal and survivor benefits altogether. Even for people who paid into the system through other employment, many families viewed these reductions as unfair and difficult to justify. Now, with these provisions repealed, millions of payments have already been adjusted. Some beneficiaries have received retroactive payments, while others are seeing meaningful increases in their monthly income going forward. For many households, this change feels like a long overdue correction rather than a new benefit. While not every public employee is affected, for those who are, the impact can be substantial. The Fairness Act represents one of the most significant benefit corrections in recent years, offering renewed financial stability and restoring confidence for many retirees entering 2026. Long-term funding concerns. What trust fund depletion really means. Even as short-term changes bring modest increases in overdue corrections, long-term concerns about Social Security remain very real. One issue that continues to surface is the projected depletion of the program's trust fund in the early 2030s if Congress does not take action. Hearing the words trust fund depletion can sound alarming. For many beneficiaries, it raises fears that Social Security could disappear entirely. However, it is important to clarify what this actually means. If the trust fund were to be depleted, benefits would not stop altogether. Instead, incoming payroll tax revenue would still fund the program. The challenge is that those revenues would not be sufficient to pay full benefits. Without legislative changes, future payments could be reduced across the board. While estimates vary, the possibility of broad benefit cuts is a concern for current and future retirees alike. Lawmakers continue to debate solutions, including changes to payroll taxes, benefit formulas, and eligibility rules. Despite ongoing discussions, no final agreement has been reached. That uncertainty leaves many households feeling uneasy as they plan for the years ahead. For those already receiving benefits, the key takeaway is awareness rather than panic. Social Security remains operational and continues to pay benefits on time. But long-term stability depends on policy decisions that have yet to be made, keeping this issue at the center of conversations about retirement security in 2026 and beyond. Overpayment recovery, when Social Security takes money back. Another issue quietly affecting many households as 2026 approaches is overpayment recovery. This occurs when the Social Security Administration determines that a beneficiary received more money than they were eligible for, often due to reporting delays, income changes, or administrative errors. When an overpayment is identified, Social Security has the authority to recover that money by withholding a portion of future benefits. For individuals living on fixed incomes, even a small reduction can feel overwhelming. Monthly budgets are often planned down to the dollar, leaving little room for unexpected cuts. What makes this situation especially frustrating is that many overpayments are not caused by fraud or intentional wrongdoing. In many cases, beneficiaries followed the rules, reported changes as required, and still received notices months or even years later stating that money must be repaid. For older adults, navigating the appeals process or requesting a waiver can be stressful. The paperwork can be confusing, deadlines can feel intimidating, and the fear of losing essential income adds emotional strain. While options exist to challenge or reduce repayment, not everyone is aware of them or feels confident pursuing them. As a result, overpayment recovery has become a growing concern. It highlights the importance of clear communication, timely reporting, and careful review of benefit notices. For many households, this issue represents not just a financial challenge, but a reminder of how vulnerable fixed-income retirees can be when unexpected changes occur. Inflation pressure and $2,000 payment talk, separating reality from speculation. As discussions around Social Security continue into 2026, many households are still feeling the lingering effects of inflation. While inflation has eased compared to its peak, everyday expenses such as food, housing, insurance, and medical care remain higher than they were just a few years ago. For people living on fixed incomes, that pressure has not disappeared. This ongoing strain is one reason rumors and headlines about potential payments, sometimes described as $2,000 checks or tariff rebate payments, continue to gain attention. For many retirees, the idea of extra financial relief is understandably appealing. However, it is important to separate proposals from reality. At this point, these payments remain ideas and discussions, not guaranteed benefits. They have not been approved, scheduled, or funded in a way that beneficiaries can rely on. Planning monthly expenses around money that may never arrive can create serious financial risk. Experienced retirees know that stability comes from budgeting around confirmed income sources, not speculation. While it is reasonable to stay informed about policy discussions, it is equally important not to treat unapproved proposals as dependable support. In an environment where costs remain elevated and news cycles move quickly, caution matters. Focusing on known payment dates, confirmed benefit amounts, and realistic expenses helps protect financial stability, even when headlines suggest otherwise. Entering 2026. With clarity, practical steps for confidence and stability. As we move fully into 2026, the most important takeaway from all of these changes is not fear, but clarity. Social Security continues to do what it was designed to do, deliver monthly payments on time to millions of Americans. Yet how those payments are scheduled, how much actually reaches your account, and how far those dollars stretch are what shape confidence right now. The January 2026 calendar reminds us why paying attention matters. Early payments, closely spaced deposits, and holiday adjustments can easily be misunderstood. Knowing your exact payment date and understanding which month each deposit belongs to can prevent budgeting mistakes that cause stress later on. It is also a good time to review your account information if you are able. Confirming your direct deposit details, monitoring benefit notices, and staying alert to potential scams can protect both your income and your peace of mind. Remember, legitimate Social Security representatives do not threaten, pressure, or demand immediate action. As costs remain high and long-term questions about funding continue, it is normal to feel cautious. Some people feel hopeful, others remain worried, and many fall somewhere in between. Wherever you are emotionally, you are not alone. Millions of households are navigating the same uncertainties. What matters most is staying informed, planning around confirmed income, and giving yourself grace in a system that can feel complicated. Social Security remains a vital foundation for retirement security, and with awareness, patience, and careful planning, it can continue to serve that role as we move forward together into 2026.